Welcome to Beyond the Chart, Module 1.2. I'm Russell. In the last video, we looked at what a share actually is and why the float matters more than the headline count. Now let's look at why a trade happens at all. Here is a question that sounds almost too simple to ask. Why does a trade happen in the first place? Every single trade, no exceptions, requires a buyer who thinks the price is going up, or is at least worth paying, and a seller who thinks it isn't, or is happy to take the cash and move on. If everyone agreed on what a stock was worth, nothing would trade. The price would just sit there, unchallenged, because nobody would have a reason to take the other side. Price moves because people disagree, and the price you see at any moment is just the most recent point where one buyer and one seller's disagreement got resolved. The next trade is a new disagreement, resolved again, slightly differently. A chart is just a long record of thousands of these small disagreements, one after another. That is worth sitting with, because it reframes what a chart actually is. It is not a forecast. It is a history of where buyers and sellers have, so far, managed to agree. Every stock, at every moment the market is open, has two prices sitting on it at once, not one. The bid is the highest price any buyer is currently willing to pay. The ask, sometimes called the offer, is the lowest price any seller is currently willing to accept. These are never quite the same number. If they were, a trade would happen instantly, and the gap would close. That is exactly what does happen. Constantly. All day. Which is why the bid and ask are both always moving. When you place a market order to buy, you're not buying at the price. You're buying at the current ask. The cheapest a seller will currently let it go for. When you place a market order to sell, you're selling at the current bid, the most a buyer will currently pay. This is worth being clear on, because it explains something that confuses a lot of people the first time they notice it. The moment you buy at the ask and immediately try to sell, you are now selling at the bid, a lower number, and you are already down. Before the stock has moved at all, that is not a trick. It is not a fee. It is just the gap between the two prices doing what it always does. In the next video, we will look at liquidity and the spread, why some stocks are calmer than others, and how that gap between the bid and ask can cost you. The full course is on School, all the modules and the community. Link in the description. If this resonates, please like and subscribe. It helps more traders find their way here. The LARKE cycle is the destination. The journey starts here.